Welcome back to Turning Hard Times to Good Times. I'm your host, Jay Taylor, and I'm really happy to have Alasdair Macleod here with us once again. Thank you for joining me, Alasdair.
That's my pleasure, Jay.
And I should remind everybody, it's goldmoney.com every Thursday. What is the specific page there? It's research,
and then insights. And
insights, that's right.
Just follow your nose from there.
Yeah, good. I recommend you do follow your nose, folks, because there's a lot of good material. It's one of those must-read pieces that I look forward to in my inbox every week. Well, Alasdair, in your June 2nd issue, it was titled Recession, Prices, and the Crack-Up Boom. Obviously people, recession, they've heard that word, prices, they know about that, or they think they do. But crack-up boom is a term that Austrian economists are familiar with, but not the Keynesians have. Well, they don't like that term, I think. They don't believe it even exists. There's no such thing as a crack-up boom. But there is a crack-up boom. It's happened throughout history. Can you define it for our listeners and then maybe also talk about how it's created?
Yeah, it's basically what the Austrian economists noted in the great inflations, the end of the great inflations in Europe in the early 1920s, was there came a point where the general public, having always believed that the currency, even though it's losing purchasing power, would never go down to zero, it would somehow stabilize. They then lost all hope of that and basically got rid of every piece of currency they could as quickly as they could for goods, and whether they needed the goods or not. I mean, the imperative was to just get rid of the money. That was the crack-up boom. The boom bit basically being the purchase of the goods, if you like, with the discarded money. And it really meant that money became worthless shortly after that point. Obviously, we don't have the same situation as, defined in that way today, but we see some signs of it. People are running out and buying things that they don't really need. And I don't know about in America, but if you look at second-hand yachts and motorboats over here, the prices are through the roof. Motor cars, second-hand motor cars, prices through the roof. Now, I mean, there's always an excuse. You can say, well, there's supply problems with new cars and all the rest of it, and people can't wait. Yeah, sure. But, when you see this sort of activity, it's ringing bells, if you like. It's not quite the crack-up boom, but it seems there's so much in common with it. And not only that, but you can see people beginning to think, well, I need to rush out and buy this, buy that, before the price goes up. Mm-hmm. And that, if you like, is very much the psychology behind the crack-up boom. So we're not actually in a crack-up boom, but you can see it's rhyming with it, if you like.
Yeah, people are starting to think that way now, I believe, to a certain extent. But there's still a lot of confidence, Alasdair, I think, in the Fed's ability to tame this thing, to get out ahead of it, even though inflation is at 8%. Now, I see the 10-year is up to, I don't know, it's getting close to 3.5% now. But, compared to 8.7 consumer inflation rate, that's still woefully inadequate to get us anywhere near a level that you would think would get a grip on or get a handle on inflation, right?
Yes, I mean, it's the Fed has got left way behind. But there is, if you like, another problem embedded in that, and that is that if interest rates were to reflect the loss of purchasing power of the currency, and it's not just in the dollar, we're talking about all the major currencies, then interest rates would be so high that malinvestments would be triggered. I mean, they would start collapsing. You'd find that bank credit, which incidentally is already beginning to contract, would really start falling off the cliff. And we would be driven into an economic slump very, very rapidly. Now, the mistake that the Keynesians make is that they think it's a sort of black and white situation. You're either in a recession or you're in growth. Now, actually, both those are expressions of the money, not what's going on in the economy. I mean, when you get growth in GDP, it's actually growth of the quantity of money. It doesn't tell you how that money is actually being deployed, whether it's being deployed economically, efficiently, progressively, however you might like to define it. Equally, in a recession, it's the contraction of bank credit, and it's the effect of the contraction of bank credit is to basically stifle any economic activity. But the interesting thing is that unlike cycles in history, this cycle of bank credit is purely financial. And it means that banks have not just assets on their own balance sheets in the form of bonds, where they will begin to ditch, but also they have collateral which secures loans, and that collateral is essentially financial, and that's going down the Swanee as well. So, this is basically something which is inherently financial rather than, the good old-fashioned slump, recession, depression, whatever word you like to use.
Right, and it's I would argue that it's when the United States went off the gold standard, created a petrodollar. It allowed the United States to have the world's reserve currency and to abuse it and to create enormous amounts of money that's sloshing around, creating malinvestment. So our 37-year-old son said, "Dad, this looks an awful lot like what we went through with the dot-com collapse to me." He's observing what's going on now. And you can see this with interest rates so suppressed. Money is free to go to all kinds of places without much consideration of its cost, right? And that leads to a malinvestment or a misappropriation of capital, does it not?
Yes, that's very true. But the point I'd like to make about this is that after the inflationary 70s, obviously what the authorities wanted was another means of ensuring that those inflationary times, the fall in purchasing power of the currency could be contained. And it was really from that moment that what they did was they started creating financial speculation. You had the Big Bang in London. You had the reprieving of the Glass-Steagall Act in the early 1990s, and this all set the scene for banks to throw capital into financial markets, markets for financial assets, and they have absolutely boomed. And consequently, people have flocked into the dollar to benefit from this. It is that speculative bubble which has supported the dollar without interest rates having to rise. And indeed, we have seen interest rates decline from the early 1980s all the way through to the low point in 2020 when the dollar rates went to zero. So that is, if you like, it was a deliberate act of policy. Now that time is now ended. It is finished. And this is the point which I think people are gradually waking up to, that it is no longer a financially driven economy. Suddenly, there are different things. The Russians have pointed the way with commodities. We find that the purchasing power of our currencies are basically going down quite rapidly, and there's a threat of them going down even more rapidly. I mean, we're talking about crack-up booms and so on and so forth. You can see that the sentiment is beginning to get into people's minds that this is a very, very different environment, and the effect on markets, I'm afraid, is to collapse them, and that's basically what we've been seeing this week.
Do you think that Chairman Powell understands this, that he sees the danger of this? There's some people that think he does, and that he would like to really do what Paul Volcker did and get a handle on this thing. But I just can't see how he can, given the magnitude of debt and all of the structured finances, derivatives and things that were not anywhere near the levels they are now during Paul Volcker's day. Do you think that our chairman understands the potential of a crack-up boom?
Well, I don't think he does. I think he sees enormous dangers. Of that, there must be no doubt. I mean, he would have to be made of stone not to see the problems that not only the Fed faces, but more importantly, the ECB and the Bank of Japan. I mean, they're looking, they have banking systems where the global systemically important banks have asset to equity ratios of, into the 60s and 70s. I mean, this is unheard of. And it's It's the consequence of negative interest rates. I mean, when I look at the average level of the asset to equity ratio in the Eurozone, I mean, we're talking about 1, 2, 3, 4, 5, 6, 7 banks. I think the average is over 50 times. I mean, excessively extended bank credit would normally be a bank balance sheet of somewhere between 12 and 15 times assets to equity ratio. Here we're talking over 50. And the same in Japan. I mean, if you look at Japan, because I've been running these figures off for the article which is coming out this week. I mean, you got Mitsuho. Their asset to equity ratio is 62 times. Sumitomo 48 times. Mitsubishi 40 times. I mean, this is unheard of, absolutely unheard of. And so now just imagine contracting bank credit. Imagine bond yields rising, financial asset values falling. We're going to have a banking crisis very, very soon, and it is going to be a major one, a really major one. And worse than that, the central banks are all in the hole themselves. I mean, I think it was about 10 days ago, the Fed said that unrealized losses on its bond holdings were $330 billion.
Wow.
Well, when I tell you that the equity on the Fed's balance sheet is $50 billion, right. And when I tell you that since that March end, bonds have continued to fall, and I would guess that the deficit is now more like $500 billion, and this is on the Fed's balance sheet. This is, I mean, and if you look at the Bank of Japan, I mean, it's even worse because they've been QE since the year 2000, and not only that, but they've got longer dated bonds than the Fed on average. Mm-hmm. The ECB again. I mean, the central banks are so underwater. Their balance sheets basically are bust. And yet we expect them to underwrite the commercial banking system in a commercial banking crisis, bank credit contraction crisis. I mean, how this is going to play out, this is a very dangerous time. And I have to say that anyone, who hasn't considered this really ought to get their brains into gear, because this is not good.
Well, the arithmetic, the math just doesn't work, Alasdair. Someone pointed out the other day that if the U.S. borrowing rate went to simply around 4 or 4.5%, 30% of our budget would be for interest alone. That's equal to what we spend for defense. It's equal to what we spend for Social Security. And if you go to the kind of rate that would, equal to our CPI or something like that, I mean, don't you think that people would finally start to wake up and see that there's no way that this thing can't implode or explode, one of the two?
Well, I think the vast majority of people are wise after the event, and
wise after.
This is certainly going to be the case with Keynesians. I mean, we're discussing this with, I think, some foresight of an event, and we're not really sharing this with very many people.
No,
I think. I mean, you mentioned the financing problems for the U.S. government. I mean, yeah, sure, but that's nothing compared with the bigger problem in financial markets, and for the currencies themselves, and for the whole economy itself. And as I say, it's not just America; it's everywhere. It is absolutely everywhere. I mean, even China has got huge, great problems, and they have put aside money in case the banks need extra capital and all the rest of it. I mean, I saw that announcement the other day. I think it was in the Asia Financial Asia or something, one of those Far Eastern magazines. So, everybody is in difficulty. The only country that isn't, funnily enough, is Russia. I know, we've got lots of propaganda about, how awful it is in Russia and all the rest of it, but actually their economy is doing jolly well. And they have the best performing currency. And when I look at the trend of bond yields, the only one going down is the Russian.
That's incredible. They had to raise interest rates from, I think Putin raised interest rates from 9, or their central bank did, from 9.5% to 20%. And then the currency sort of stabilized, and then they came in with backing, or let's say they tied the ruble to, I think, 5,000 5,000 rubles per gram of gold, at least for a temporary period of time. And then they came out and required unfriendly nations to pay for gas in rubles. And the currency has just gone really nothing but straight up since then, compared to everybody else's. And yes, we don't hear the good news. We don't hear, well, it's not good news, I guess, to the adversaries of Russia, but they were doing pretty well. I want to ask you this, though. You mentioned that that Russia is putting this together to protect themselves. They are really forcing the world to look at money backed by something that's real rather than just hot air, right? And so you see this as a way that Russia is protecting themselves against the carnage that could come from, from a dollar disaster.
Yeah, there's been a change, Jay, in their approach. I mean, up until very recently, they were at financial war with us. There's no other way to describe it. And now I think that war has effectively paused, because what Russia is now doing is it's protecting itself from what it sees as the inevitable collapse of the Western financial system. Mm-hmm. And the way it's done it is it's in effect tied its currency to energy prices, and in the broader sense, let us say, commodities. So they've made it a sort of commoditized currency, whereas our currencies are all based on yesterday's financial story, which is now over. Mm-hmm. Because interest rates are rising, and they're going to rise to the point where the whole system falls over. I mean, just look at those numbers I was quoting about the ECB, about the Eurozone banks, about the Bank of Japan, and the Japanese G-SIBs. I mean, this is a very, very simple conclusion. They're all going to fall over, and interest rates will rise to that point. So it's a very dangerous time.
Well, you mentioned in one of your recent articles, I guess it was the one I'm referring to. No, actually, protection from a currency collapse. Last Thursday's article, reasons why why governments don't really want to go that route and back their currencies or go to a gold standard of some kind. And you're suggesting that Russia is sort of going to sort of a quasi gold standard or something related to it. But there are a number of reasons why governments don't like to go to honest money. They like to, I guess, because they like to be involved in dishonest vote buying. I don't know, but I was wondering about the cryptos, which have really fallen out of it. They've really gotten smacked down really hard. And a partner of mine named Chen Lin, who we do a lot of things with, observed that the U.S. government has come out in favor of stablecoin recently, has made some very strong positive statements about stablecoin, and he thinks that may have caused the cryptos to take a hit. Does that make any sense to you?
Not really, no.
No.
I think that, the stablecoin situation, funnily enough, I was looking at Tether today, and it appears from their statements that they are all in short-term stuff. There's something like 6% of their assets are in crypto. Oh. Now, that is the danger, I think, to, that could force them to break the buck. But it's not it's not a really serious situation. I mean, the fact of the matter is that cryptos are just a speculative play as an alternative, and it seems in terms of correlation anyway, as an alternative to some of the hairier tech plays. They're going down, and Bitcoin are collapsing with it. And I mean, the fact is that Bitcoin can never work as money. And when people understand it's just a speculative play, I think it'll be dead.
All right. With just a couple of minutes left, I have to ask you about gold. It's not performing terribly well so far with inflation where it is. I know interest rates are rising. The dollar is getting stronger vis-a-vis other trashy currencies. The West, the yen, for goodness sakes, which is going to hell in a handbasket. The euro isn't a whole lot better. And I don't know about your currency there, Alasdair. I don't want to be disrespectful to your but why isn't gold performing better? Because I know a lot of people would like to hear what you have to say.
Okay, it's very, very simple. Basically, the whole of the investment establishment is Keynesian and doesn't understand gold. It thinks that they've moved on from gold. which is why, people are sort of looking for alternatives. And this is why cryptocurrencies like Bitcoin and so on and so on. So that is, if you like, the underlying reason that they always get gold wrong. First they get it wrong, and then suddenly they begin to realize that actually, the best protection is gold. And we will see that. The other point I would like to make is that the system, by which I mean the bullion banks, are desperately short in the paper markets. They are trying to close those positions down ahead of the half year end, at the end of this month. Mm-hmm. And so they are in a desperate attempt to try and smash the price of gold in order to close their positions, or at the very least have a valuation point which does their balance sheets the least damage at the end of this month. So, if I'm right about that, and I'm convinced I am, what you will see is that after the end of this month, you will see the gold price begin to recover. They've already gone long of silver on COMEX, net long of silver on COMEX. Uh-huh. So this is something, every time this happens, when they get into a position where they can see the gold price is going to rise, they have to hit the price, persuade us all to sell to them so that they close down their shorts, and then we're off to the races. And that's roughly where we are.
Well, it would certainly make sense. Thank you so much, Alasdair, for your time again and for sharing your thoughts. Very much appreciated by our listeners. And we'll look to keep up with your story that's coming out tomorrow. What was it again? Your title? You're going to.
Well, it's actually actually on Thursday.
On Thursday, I mean.
Yes. I'm looking at the banking system, and it's an absolute horror show.
Okay, well, I guess you don't have to go to movies anymore for horror shows. You can just read. Well, we laugh, but it's not really a laughing matter. Thank you so much, Alasdair, for being with us. Always a pleasure having you.
My pleasure, Jay.